Awesome. So Josh, coming up here. So Josh is going to introduce us to a couple of his lending partners to really kind of go into this topic deep. And Hillary kind of proved the point of why this conversation is so good is because she's thinking of all these people that, hey, maybe this would be good for this person. Their house is in this disarray or whatever. If they could buy this property by getting a renovation loan, then they're not buying a fixer upper and have to say, so there's just all these things that are just coming up in conversation about it. So let's start with the dialogue and the presentation that Jim and Aaron's here in person with us. Come up here for just a second and let you both introduce yourself and then introduce Jim. And let's just kind of go into it. And then we'll do some more Q&A after. Hillary's got a good list going already. No, those were great questions. That's what everybody kind of wonders. And we talk a lot about this in our office. Is like, these trainings are going to help us do more business because we're going to be better equipped to serve our clients. So think of that while you're listening to this, like Hillary's already done, is somebody that she can talk to about this type of a product that would help them either buy or sell easier because they don't know. We don't know. I mean, the slide's not still up there, but 9 different renovation loans, meaning there's different applications and different scenarios where this one would work or this one would work. And how many of you even knew about 2? Right? It's just not something that's part of our normal world. So I'm excited for this topic. Glad you guys are here. Hi, Shayna. So Josh, take it away and introduce your crew and let's go into the presentation.
All right, sounds great. Thanks so much, Jeff. Yeah, so I'm gonna do very little talking at the moment. I may jump in on the Q&A. So Aaron is with Plaza Mortgage. I'm a mortgage broker, and Aaron's been with me, working with me at this company. Plaza has the biggest and best array of renovation loans across the country that I know of, and so that's why we're here. Aaron's guy, Jim, is on with us as well. Jim's actually going to present. He's in Chicago, so he gets to tell us all about what weather in Chicago is like.
You don't want to know.
But he's going to do the majority of the initial presentation and a lot of the Q&A. Jim's all day, every day is in the thick of this, working with the contractors, doing the draws and such like that, kind of managing the crew that does that. So he's gonna actually do a lot of the presenting. I just want to start off with kind of pointing out where this really connects. So for me, a renovation loan is actually a career builder. Like, this is something it's a niche that you can build your whole career around if you wanted to, or redefine your career if you wanted to, since this is such a unique market. With the renovation loans, we can literally sell a meth home to a regular home buyer if we wanted to. Obviously,
you said meth home? Okay, but blah, blah, blah.
After we fix
No.
it. We'll fix it. But we've got mother-in-law apartments and such, a house that doesn't have it, that we can do the walkout basements and things like that. New construction stuff Jim's gonna get into, where we can help people finish their basements, finish their landscaping, whatever, put a pool in. And so you can literally, instead of just going the normal, there's a whole bunch of problems that people have that we don't even realize, and none of us really think about it, that this is gonna open up some solutions for it. And so I'll just kind of set the stage for that. Now that I've made promises that Jim has to keep, we'll go ahead and turn the time over to him after Aaron says his piece.
Oh, no, we're good.
Okay.
I appreciate Jim hopping on like this, so I'm gonna kind of let him take it away, but Josh and I are gonna be here well after. We're gonna answer all your questions, so. But anyway, Jim, thanks for joining us, and
Yeah.
we're gonna let you do your thing.
Okay, I'm going to address the meth home real quick. The answer is just no, don't sell anybody a meth home. Just so you know. No selling of meth properties. So that's okay. So I could give you a list of reasons why, but yeah, you don't want your buyers to do that. So I'm going to start out. I don't know what you know or what you don't know or what you want to know, any of those things. I'm just going to tell you what it is. We do renovation loans. There are so many renovation loans. Can you guys see what I'm sharing? Yes, no, maybe so?
Yep, see your screen.
Perfect. Okay, I'm just going to give you a quick overview of what a renovation loan is. It's really just a 30-year mortgage with what we call maybe a renovation or a construction feature. What that means is somebody is looking to buy a house. They're working with you. Say that they have everything checks the boxes except for the house. So you've got the right location, you've got the right school district, you've got, it's the right lot. Everything looks great, right? Everything's good. It's close to where they want it to be, but the house isn't. Maybe it's the house is dated. Maybe it's only a 3-bedroom, 1-bath. You know, maybe it does have an unfinished basement. You know, maybe it does need stuff in the backyard. This type of loan can turn a house that they would otherwise overlook as a buyer because it doesn't fit their needs into a house that fits their needs. And what I mean by that is you can actually do a 30-year fixed mortgage. You can buy the house and then finance the cost of the renovations to make the house the way they want it. So it's literally just a purchase, get a bid from a contractor, you get all that stuff done, and then you wrap the cost of all that into the financing. So I'll give you an example. Say that you have a buyer looking at a house that's, you know, say they're approved for 500,000, but there is a location they're particular about, and all the houses and their price range at that, there just isn't any available, right? But say that they have a crappy house in the neighborhood that's like 350, but it's not the right size. Say that they put 100 grand into it, and then they renovate the house and they do the finishes they want. They put a room addition on there. You can actually do that as a rental loan. It might get them into that right neighborhood in the right spot. It's still the wrong house, but you could make it the right house. It's good for tough homes. It's good for homes that just don't fit their needs. It's good for dated homes. It's good for estate sales. It's great for foreclosures. It's just not good for meth houses. But all of the other stuff, it's great for. So it is literally just a 30-year fixed from day one. So there's a lot of certainty behind that. It's not like a construction loan where you have 2 separate closings. The borrower has to qualify later on, a year later when the stuff's done. You've got to get another appraisal. This is kind of one package. We do one appraisal subject to the work from the beginning. Borrower knows what their payment's going to be. They know what work they're going to get done. It's a great product for a lot of these difficult properties or borrowers that are just struggling to find anything because there's just such limited inventory.
Hey, Jim.
Yeah.
I just want, before we get too far away from what you just said, I want clarification on that. You said it's just not good for meth houses. Why? I mean, why couldn't you buy a house that's contaminated with meth and get the rental loan to clean it up, put in new flooring and repair that situation? Why would
we have actually decided not to do meth homes because we did one once and the house was a teardown. Once you start ripping into it, that stuff seeps into everything. We have had a house where you had to basically, there was nothing we could do to keep it.
Basically, you just don't do them. That's just like
basically we just don't do them.
Policy is what he's saying.
Okay, perfect.
We just, yeah, too much EPA issues with cleanup and phase 1 environmental.
Actually comes up. Right, it doesn't actually come up very often. I say it, but nobody's actually called me on it.
Yeah, if they do, well, just run screaming. That's my advice.
And I'm gonna add something real quick. So a renovation loan isn't one where you're gonna demolish the house.
No.
That is not a renovation loan. So just.
Yeah, but I've cleaned up a lot of meth houses
Okay,
that are contaminated with meth that don't need to be torn down.
gotcha.
Hunt's area.
Yeah.
Yeah, Terry's actually bought a couple of them. So it's actually an easy cleanup. You know who to use.
Got ya. Well, maybe we'll take it as a takeaway, but
Right, no worries. I just wanted that clarification and
Yeah.
so we're talking about your programs and that's just not part of it. So that's all good.
Yep.
Thanks.
Okay, cool. Yeah. So here's some misconceptions versus opportunities. When it talks about rental loans, this slide's a really good one. A lot of times your borrower, maybe they buy a house and they just get into it and we'll figure out stuff later. You know, it is not as easy to buy a house for 300,000 and put 5% down now and then figure out where to come up with 100,000 later. When you could just do the whole thing for 400,000 and come up with 5% of 400,000. That's a great way to put somebody in a house and get all the work they want to have done without them having to figure out where to come up with the money later. So that's what I say by, we can figure out the renovation after we're in. We'll have to wait until we can afford them. They might be able to afford them now. They don't have to look at move-in ready homes. They don't have to look at homes that fit their needs. They could make all of that happen. And on the real estate side as agents, a lot of times there are a lot of misconceptions about renovation products. They think it's for foreclosed homes only, or the seller has to do the work before we close, or I can't sell the home because it doesn't meet minimum property requirements for any of our programs. Actually, none of those are true. You can actually do it for anything. It doesn't even need to be a foreclosure or an estate sale. It could just be dated. It could just be too small. It could just be all of the above and they want to fix it. The other side of it is they take too long to close or they're too complicated. And again, that is a huge misconception. I'll give you an example. We had a loan that came in our door on January 3rd, and it was a standard 203K. It was about $90,000 in work. The loan was approved by us on January 5th, and it was funded on January 24th. If you count business days from when we approve that loan with a holiday in there, 4, 5, 12 business days, we have that loan closed in. So depending on how engaged all of the parties are, contractor, if a HUD consultant's needed, borrower, if everybody's on the same page, these things can go pretty quickly. You know, that's a really good example of a loan officer who's been, you know, who has literally embraced renovation loans and has been doing them with us for a long time. They, you know, they learned the hard way. They started their first loan with me 5 years ago. Now they can send me a loan and I can get it closed in less than 30 days.
Jim,
Yes.
what's a HUD consultant?
A HUD consultant is a third party that does several things. If it is a standard 203K, their go-to is going to be what we call an initial work write-up and specification of repair. Their job is to go out to a property and inspect it to make sure that all of the work that their contractor is going to do will bring that property up to minimum property requirements. They can also do feasibility studies, meaning like if you have a borrower that wants to do a renovation loan on a house and they're not quite sure if they want to, you know, go to the house and do all of this work and they want to make sure that it's okay, the value's there, it seems reasonable. The feasibility study is great. They can go out, do the inspection on the house and give them an estimate what it would cost to bring it up to property standards and what it might cost for them to do the renovations they need. The other piece for that they do is when the loan closes. When the HUD consultant does that initial work write-up specification of repair form, they're actually going to be the point of contact for all draws. When your contractor needs to get paid and the borrower's like, hey, I need to get money, they call the consultant. They go out to the property, do an inspection, fill out the paperwork, send it to our servicing department, and we cut a check. Contractor keeps working. So HUD consultants are pivotal in getting these loans done and helping the contractor and the borrower through the servicing process while the work is being done. They kind of help keep the contractor in check and make sure the work is going. They actually help them with any change orders if stuff comes up. You know, when you open up a wall, when you're renovating a house, you don't really know what's going to happen. Contractors are, you know, they're not psychic and they don't have x-ray vision. They can only give you, you know, what they see like we do. You have an appraiser go out, they can only see what they can see. You know, so we do have that third party that's there to help you kind of navigate those things. So you're welcome. Benefits is my next slide. Let's talk about benefits of doing a rental loan. They're really not bad. Borrower, they can explore more home choices. They can immediately add equity to their house. They're great for people who are limited on funds. You know, like I said earlier in the example I was talking to you about buying a, you know, buying a house for $300,000 and then you need $100,000 in renovation. Why don't you just do it as a renovation loan? Because you're doing 5% down of $400,000 versus 5% of $300,000 and then looking for the $100,000 later. This is a great way to get them in with a lot less money down. On the real estate side, it's a great, it's, you know, like you touched on at the beginning, it's a new stream of business. It's helping your customers getting things. You can, you know, overcome objections to purchasing this house. It's not the right house, but if you do it as a rental loan, you could make it the right house. You know, a lot of people see houses that are flipped and they look nice on paper, but sometimes they're settling. I'll give you an example, like maybe they don't like the finishes, but they're brand new and they're like, let's move in ready. I'm not really a fan. Say you buy a house that still needs work, but they get to pick their finishes. It's a great way to get somebody into the house they really want. You don't have to say no, and it's just another option you can offer to your buyers. And obviously from a loan officer perspective, you know, we're here doing exactly what we need to do to get that message out to everybody. You know, like from a loan officer perspective, we just talk about it, telling you how the loan works, what we can do to help you get that tough listing financed. You know, like it's just a great way to get people into homes they would normally not. Target is huge on rental loans. Save a loan is the biggest one that we do a lot of right now. FHA is a huge, you know, save a loan kind of situation. You know, like say that you have a buyer that's looking at a property and all of a sudden the appraisal comes back, they're under contract, everything's going great, appraisal shit, it hits, and then all of a sudden you have, we need work to be done. Seller doesn't want to do the work. You know what? Instead of walking away from the deal, flip it to a rental loan. Get a bid from a contractor, get that work done, finance it in, move forward. Seller gets to sell, buyer gets to buy, everybody's happy. Seller doesn't have to do the work. You know, neighborhoods that are now finally seeing turnover, it's got a little older housing stock, people are moving in. You know what? That's a great opportunity to get them into that neighborhood. People want to add space to work from home. They want to add detached offices and studios. They want to add ADUs. You want to have a space to educate at home. You want to have a multi-generational household. You've got deferred maintenance. The list is endless of things that you could do with rental loans. It just keeps going and going. What programs? So I'm going to send you another slide. We have a comparison for every single program that we offer. And so let's see. Now everybody can see this. Is it small? I'm going to make it bigger.
We can see it and we got a flyer.
Yeah. I
Okay.
printed it up.
Oh, you got a flyer. Okay. So this is our lineup of rental loans. I know that there's only 2, 4, 6, 7 on here, but actually we've broken out a couple in between these, and I'll go over them real quick, just a high level. So limited K, that's going to be the saver loan I talk about a lot. Like, say the house needs a new roof, it's got peeling paint. You know, maybe it's missing handrails, just stupid little things, and maybe the seller doesn't want to handle it. Flip it to a limited K, get the roof done, get the peeling paint taken care of, get it all done, and then, you know, deal's done. Everybody gets to buy it. Standard 203K is more of the meatier version. That's the one where you can do gut rehabs, room additions, you can do new kitchens, new bathrooms. There isn't a limit. You can do structural work, foundation work, you could finish out basements. The only thing you have to be careful with on the 203K products is luxury items. We can't do things like marble countertops or in-ground pools or detached ADUs or studios. You know, we can only do whatever HUD allows. You know, HUD's not big on anything that doesn't just say you could live in the house, basically. So, but it's a great program. We do a lot of the both, and they're great. The conventional ones are going to
Hey,
be.
Jim,
Yep.
real quick, I just want to interject. So just so you guys know, an enhancement FHA recently made, let's say you're doing a standard 203K. And let's say you convert that basement into an ADU. You
Yep.
can use up to the 50% of the projected rents to qualify for that mortgage on FHA. Now, Freddie Mac, you can use 75%, but I wanted to mention that FHA, the ADU has to be attached. And it is only 50%. Whereas if you go Freddie Mac, the conventional one, it can be detached and you can use up to 75%. But I just wanted to throw that out there because obviously we know how many people are looking for, hey, I want an ADU, or I wish I could rent out part of this property. So,
Oh,
So,
yeah.
and it's projected rents, you don't have to have a lease?
correct. Yeah.
No, we'll
Right.
just use the 1007. You've
Yeah,
done.
yeah.
Yep, comp
Okay.
on the appraisal.
Okay.
Another question, Jim.
This might be answered later on, but if I already own the home and I want to do renovations and I want to refinance, can I refinance with the renovation loan?
Absolutely. And
Yeah.
you're gonna use the projected, what's it gonna be worth after the renovations are done? And it's considered a rate and term refi. So let's say it's worth 500, it's gonna be worth 650. On an FHA loan, you could go up to 97.75% of that LTV. So.
Yep.
So I mean,
95.
yeah, so.
So
Yep.
those old properties that need a renovation.
Yeah.
For some reason, the rates come down low again.
Well, and here's another example. What if someone owns their property and they want to build an ADU on their property? What a great opportunity just to utilize this loan, so.
Yep, it is.
I
So
think-
Sorry.
Hey, Jim.
Yeah.
But
I guess this is the question for Jim and Aaron. Just so that this is something I don't have the answer for. So if somebody does a 203K today, they're in an FHA loan, the rental rates are just slightly higher than the regular rates. Rates are trending lower, summertime comes up and we're able to do a streamline for them. Is there any restrictions from the renovation loan that would prevent them from doing a normal streamline?
Yes, 2 things. So thing number 1 is going to be the renovation has to be 100% completed, and that renovation escrow has to be closed out and title has to be final. And then the second piece is, and this is what Aaron can touch with you, that's our recapture. So you've got to wait out the time limit from when you originated the first loan, if it was with us, before it gets paid off.
6 months.
Which is 180 days, basically 4 payments, right? Because you take out your loan and the second month you're making your payment. So that's a great way to think about it. You're gonna wait 6 months.
So obviously, as long as the work is completed and as long as we meet those minimum 6-month plus requirements.
Yeah.
Yep.
Sure.
That's a streamline all day long. Yep,
Yep.
you can do it.
Cool. And just for you guys listening, streamline benefits, there's drawbacks and benefits. Streamline is, there's no qualifying. There's no
No appraisal, no anything. Yeah.
There's no nothing, but there's also no costs added to the loan. That's the drawback, which makes it a little bit harder to qualify, or people need to bring money to closing or something like that. But anyway, just a combination of tools that I wanted to clarify. Thank you.
Okay, so let's move on to conventional reno. So conventional is like the big mama of all reno loans. And when I say that is because the sky's the limit when it comes to what you can do to the property. I mean, you can do On top of all the things you could do with FHA, we now add another like literal class of things you can add, meaning luxury items. You can add in-ground swimming pools, outdoor kitchens. You can add outdoor studios, detached ADUs. You could put in second story additions, back end additions. There's all kinds of things. People who have water rights have put in permanent boat docks using this loan through us. There are so many things you could do with the Fannie Freddie loans. You also get the higher loan limits. And as Aaron said, if you're using Freddie Mac's version to do an ADU, if you have comps, you can use up to 75% of the rental income from the appraisal to offset their mortgage payment to help them qualify. We also have different occupancy types on those. Say you have somebody looking at an investment property or a second home. You can do those as a single unit on either of those products. It's not for fixing and flipping, but say somebody wants to buy a second home and it's kind of an old dated one that's been in somebody else's family for years. They want to buy it and, you know, update it so they can use it for their family. Say that they want to buy an investment property, like a single family, and rent it out and, you know, maybe start investing in the residential real estate market. Those are great programs for those kinds of buyers. You know, the minimum down payment. Sorry,
just to clarify, and I want to make sure you guys caught that piece. When you're doing these second home investment properties, you cannot do multi-unit renovation.
Single
So
unit.
someone, hey, I want to buy a triplex and do a renovation. No,
Single.
it has to be single family. So
As a second,
what's that?
as a second.
Second
Or
home or
investment.
investment. It has to be units.
Single
Cannot be
unit.
Even though the ADU technically is that.
Oh, yeah.
Yeah, ADUs are considered two
Owner
units.
occupied, yes, but not for second home or investment property.
No investment fourplex renovation?
Nope.
So on this sheet right here where it says Fannie Mae Homestyle and Freddie Mac Choice Renovation says 2 to 4 unit of primary residence.
Yeah,
Primary residence only. Yep.
I just wanted to put that piece out there to clarify, so.
Yeah. 2 to 4s need to be primary. An ADU does not change a property to a legal 2 unit. It's an accessory dwelling. Even though there is 2, it's still not really a 2 unit. It's still considered a single.
Perfect, thanks, man.
So, and then we just closed a pool loan on one of these. It's actually closing today. They bought a brand new construction house. I know we touched on that earlier. And you know, home builders don't do pools. This person wanted a pool. We are doing their new construction house on a rental loan to add the pool after closing. We do a lot of those. A lot of people want to build a new house and add a pool. Builder doesn't do it. We do it as a rental loan. They get a pool company. Easy peasy.
Hey, Jim, wouldn't that change their out of pocket though? Because you're not gonna get full value for a pool on an appraisal.
So the example of the one that we have closing today, you know, they bought the house and this pool is expensive. It was $126,000 pool. It's a very nice pool, I have to be honest. The value they got out of it was $70,000. They had to bring in the difference, right, to make the deal work. But you think about it, they only had to bring in $50,000 to get a $127,000 pool. It was a great deal. Still cheaper than, you know, trying to figure out how to come up with $100 and something thousand to get a pool after closing.
Yeah.
Yeah, for sure.
It was, you know, they knew they were coming in with money and they had the money set aside. They just didn't want to use it all. And their agent was armed with comps when they sold them this property. They said, oh, well, the ones with pools are selling for this much more. Guess what? They knew that they could utilize that value based on those comps their agent provided. So they would only have to bring in an additional 50 grand to get this pool done versus paying for the whole thing out of pocket.
Hey, Jim.
Not a bad deal.
Jim, just for your information, a market comparison, everybody around here is snickering because 126 grand for a pool sounds like a kiddie pool in Utah. So I don't. What
This was
Chicago-
Texas. It's Texas. Texas things
Texas.
land is cheaper, just so you know.
Just FYI, Utah pools apparently have better water or something.
Have better water. Love that. Yeah, they have better water. Yeah, I mean, we've done pools that are $200,000, just so you know. But like, yeah, I mean, when you're in Florida or Texas, there's so many pool companies. I think there's a lot more competition. Because Texas, they're much more common in Texas and Florida than I think they might be in Utah.
Tell them to move to Utah. We'll take it.
Yeah, like, I mean, we have done expensive pools, but yeah, I mean, the average price of a pool in Texas, I would say, is about 90 grand.
Wouldn't it be nice?
Yeah. So like, okay, so yeah, all of the above with the Fannie Freddie. And then we also, just so you know, I don't know how many buyers you have that do look at manufactured homes. We do allow manufactured homes on all of our products, except for USDA, just so you know. USDA is the only one we can't do it, but say that you have a manufactured home and they want to buy it, it's on acreage and it needs some work. You can actually buy an older manufactured home and do cosmetic updates to it using a rental loan. Just wanted to put that out there. I don't know how many of those you actually run into, but if you ask, we have it. That's all. The third products we have are the USDA. I also don't know how many of those you guys run into, but if you do, it is still a true no money down loan, and we can tie in the renovation for it. As you guys probably
Can you
know,
repeat that, Jim?
USDA is a no money down renovation loan. We use subject to value, and if the value is higher, we can even roll in closing costs. It's truly a no money down reno loan.
Yay.
The only thing we have to worry about is it is a little bit quirky or on credit to qualify your borrowers. You know, there's income requirements and DTI requirements, but it's not a bad loan. I mean, honestly, we have closed a handful of them. They're great. You know, if you've got the right buyer and the property is USDA eligible, this is a great way to get somebody into a property with no money down and get renovation done at the same time. It's, you know, as long as they qualify, that's great. Oh, there is a great question. That last row has max rental listed at 25,000 max. That's for a what we call limited Homestyle transaction only. We have kind of carved out a couple of other products out of the Homestyle and Choicer, which is the 9 that Aaron was referring to. So we have what's called like a limited Homestyle. And what happens if you've got a small project that's total, including contingency and soft costs, for 25 grand, we're not going to ask for a HUD consultant. We're going to do one draw with one final inspection. It's kind of like an easier version of a conventional renovation loan. So I just wanted to point that out there. That's why there's only 7 on here versus 9, because we've got a couple. We've pulled out a pool program for just pools, and we also have like a small limited program. But as far as costs are concerned on our standard rental products, we cap costs before an exception at $350,000. So you could fit a lot of work in $350,000. Okay, so USDA, pretty much talking about the no money down. It's just got to meet USDA requirements. It works just like a standard or limited 203K. We have both versions, limited, standard. You know, the ones up to 35,000, nothing structural for limited, just like a 203K. And then the standard is whatever it costs. You've got to have a HUD consultant, and it's subject to value. So both great products. If you run into them, they're great. Then the last one we have is going to be the VA renovation, and that's great for veterans. And it is the most restrictive of our products because VA has their own rules on how we are allowed to lend on them. So for instance, we're capping all of our costs at $50,000. The reason is VA does not allow the contractor to get any money at closing, whether it's materials, permits, nothing. We can release nothing. So most contractors won't do larger jobs without any money up front, which we all know. The other thing is they restrict the amount of time the work can be done after closing. All of our products start out at closing with 6 months or 180 days after closing you have, and you can get extensions in servicing if you need more time. VA, they're at 120 days. You've got to have that project done in 120 days, and you can't get any money from them. We can do some draws, but you can't get any upfront money. So we allow up to $50,000 in renovations. It's still no money down, and the work needs to be done in 120 days. But it's great for properties that as agents will never pass a VA appraisal. We know how tough VA appraisers are on a lot of properties. This is a great solution for that. Yeah. You know, if you have a buyer looking at a property and the listing agents won't take a VA offer, well, if you're giving them a VA reno, it doesn't matter anymore. Any of those items that would come up on appraisal, we can address. Any minimum property requirements, peeling paint, new roof. We can do some small structural stuff. You can add, it's a great product for doing things like ADA accessibility. We have done a lot of VA renovation loans where we've added, wheelchair ramps, elevators. We've added ADA compliant bathrooms and kitchens. We have redone flooring, so they're all one level. We've done a lot of things with VA reno for veterans. It's great. You could get we had one where we just did siding, windows, and roof. All kinds of things you can do. You can do kitchen upgrades, flooring. You just got to be careful because we got to make sure that it can be done in that 120 days. Oh, here's another good question. Does the work need to be done by a contractor, or can the homeowner do the work? The answer is homeowner can do zero work. They have to hire a contractor.
And can that be their contractors, or is there an approved list?
They can use any contractor that is licensed, insured, and experienced. So I always tell people if they're looking for a contractor, lean on your friends, your family, your real estate agent for a referral. You guys are a bunch of agents. You probably know contractors.
Can
So-
the homeowner be a licensed general contractor and that counts, or do they have to hire a third party?
They would still have to hire a third party. We do not allow, even if they're a licensed general contractor, we do not allow them to be their own contractor on their property.
No, you still have to have that contractor, and correct me if I'm wrong, Jim, but they have to put in a bid for the labor and stuff, right? So the homeowner can't do their own labor and everything. right?
No, homeowner cannot do their own labor. Nope.
All loans.
Yep. That is
That's what
across the board. We do on a limited 203K have a self-help option, but it's meant for more like you're going to use Home Depot to do your floors. So I'll give you an example. Say that you have a house that they just want to get new floors and they want to use Home Depot. So in that scenario, the way the limiteds work is it pays 50-50, right? So what we do in a situation where they use Home Depot is they don't fill out a contractor package, but we know that they vet all of their contractors for those types of jobs. So on a limited 203K, we would just get the quote from Home Depot. We'd have the borrower sign what's called a limited self-help agreement. We'll give them half the money at closing. They need to find the other half to pay Home Depot to do the work. Once it's done, we'll send out an appraiser for a final inspection and we'll reimburse the borrower for the other half that they had paid out to Home Depot to get the flooring done. That works really well if it's just a really small project and they just want to get it done through something like Home Depot. It's great on those limited 203Ks. We do a pretty good amount of those, surprisingly.
Where that might come into play here in Utah is someone, because obviously RC Willie does a lot of floor covering, so someone could go and do that and get half the money. And
Yeah, like at a floor covering company. Yeah.
Yeah,
I mean, yeah, if we have
absolutely.
some of those, that would work too. It's kind of the same as Home Depot. You know, they would just do the limited self-help agreement, use the flooring company, and that flooring company will do the installation. The borrower will get reimbursed when it's done. Yeah, kind of the same thing.
So I was gonna mention something, so when this loan comes in, one of the things that we do is we look at the experience that that contractor has and we approve them, right? I have one recently, and Jim's very well aware of this one, it's down in Green River, Utah, and tried to use a general contractor who hadn't even been licensed for a few years, right? He's probably doing a lot of cash deals, handshake kind of stuff, small town, so we had to find a different general contractor to complete that project. So just to give you kind of an example, but as long as they're, like I said, licensed and insured, they've got experience doing it. Probably shouldn't be an issue, so.
Yeah, Jim.
Experience and license. Yes.
So you get the bids, the contractor, you know, all the proposals, the work gets done, we send out the head consultant or whatever the situation is to verify the work's done, you're ready to make a draw. And it comes in, let's just say that the homeowner ends up doing a bunch of the work, and so the contractor bills for $3,000 less. Is it still gonna work out and you just have that $3,000 now left over? Or are you gonna?
If we have word that the borrower is doing work and the contractor is letting them do the work and we get that through a draw request, we will send out what I lovingly refer to as our nastygram. That borrower is now in breach of their renovation, their rehab agreement. They signed at closing and we will foreclose on their house.
No messing around with homeowners getting sweat equity.
Nope, that's not allowed.
But if the contractor did the work and just happened to come in under cost, then you have leftover money that's no longer needed for the renovation.
Principal reduction.
Yeah.
That's a principal reduction.
Yeah, and also a side note, when we're structuring these deals, it's not just, so let's say the renovation is $100,000. We're gonna do an additional 10 to 20% as a contingency. What if the costs come in a little bit higher? What if there's more labor? So so we're gonna have that additional kind of cushion if it's not used, principal reduction at the end of the.
Yeah.
Aaron, you just mentioned contingencies. That's something wanted to ask, because we've been going through these columns, but we've kind of skipped over the middle row there where it talks about contingency reserves.
Yep.
Can you explain that for us?
Yep. Contingency reserves are for what we call unforeseen circumstances and, you know, cost overruns that are just, again, contractors don't know until we get into it. So depending on the property, out of the gate, we always require at minimum 10% of the project cost be factored into the total. And that is literally for you open up a wall, you see something and we can't, you know, there's no money in the budget to fix it because we didn't know it existed yet. So in that 10% starts at just normal properties that are fine from, you know, an appraisal perspective, everything's great. The contingency reserve does change depending on the property's condition. For instance, if the utilities are off, then we automatically go to 15%. If there are other issues like mold, asbestos, you know, say that we've got structural issues, say we've got unfinished construction, or we've got unpermitted anything, then we're automatically going to raise the contingency to 20%. And from experience, I've been doing rent loans since the 90s, and I can tell you that 95% of loans use some contingency, and I would say 5% of loans exceed contingency. It really just depends.
Is that a cash reserve contingency required by the buyer, or is that a loan reserve?
It is. There's two ways the buyer can handle it. There, you can finance it as part of the loan. We do it as part of the calculation. So if we have a $100,000 project, we do 10 grand on top of that, and then the soft costs. So say that, you know, that's 110,000 plus your HUD consultant and your draw fees. We add all that together, it's 115,000. We're going to add that to your purchase price, and that's how we calculate their down payment. And now we're hoping the subject to value is, you know, the 300,000 plus the 115,000. So we're looking for a 415 value. But if the borrowers have extra money and they don't want to finance it, because if they do not use contingency in that scenario, if it's financed, it is a principal reduction. But if the borrowers have extra cash, they can self-fund the contingency to us, meaning they'll bring us the cash at closing. We'll hold it in the renovation escrow. Once the work is done and they didn't use contingency, or maybe they only used part of the contingency, and that scenario, we'll refund that contingency to them via check. So they have two options. They can finance.
Basically, the best way to do it would be to qualify as a loan contingency, and then they can determine their cash out of pocket based on ability after the appraisal.
Yes. Yeah, exactly. Because if it's financed, they're only going to do 5% of the contingency reserve. But if it's cash, it's dollar for dollar. So if your project is 100,000 and your contingency is 10,000, if we finance it, they're only going to bring 5% of that 10,000 in if the value's there, right? But if they pay cash, they're bringing us the extra 10 grand.
Perfect.
So just so I'm clear, every one of these loans you need a contractor, is that correct?
Every single one of these loans require a licensed,
Right.
insured, experienced contractor.
So Ian brought up as an example, he did a ADU unit at his house and he built it, but you said he could still probably get a loan. Does that mean he can't get a loan now?
What do you mean?
So that's different on a
Yeah,
refinance.
it's different on a refi.
Okay,
So,
all right,
yeah.
that's where I was getting.
To qualify for the purchase, they're going off something that hasn't been done yet, so they're
Okay.
requiring it to be done by. So on a refi, they're going off of the value of what it is anyway. They don't care who did it. It's like, what is it,
Yeah.
right?
And yeah, and I can answer, without Jim, I could answer further questions on if you wanted to refi. So, because you've got an existing ADU, but someone could go and do a refi and build an ADU. So in that instance, if you're building an ADU, yes, you do need a general contractor. So,
Okay, but if it's
So there's a
already
future.
done,
yeah,
you're just refinancing, it don't need to be
Yeah.
done by.
well,
contract.
we wouldn't even need to do a renovation loan that.
You're just getting an
existing.
appraisal.
Yeah,
Yeah,
it's just
you're just
that's just a regular refinance, but, yeah.
I mean, but then the buyer, if it's not permitted or anything, and they go through it, or the appraiser finds out that it's not.
Well, that's that's
Well,
different though,
different,
because you're talking about refinancing it as the owner
Right.
and having it. If you're selling it, their loan is basically what they're buying anyway. It's the same as any other buyer.
Yeah, so pretty much like if I have a property that that the city's like, hey, I can build an ADU detached on the property. And could I go refinance it through one of these options and have a contractor build that detached ADU on the property?
Yeah. You can do that if you want to do a refinance, like say you own it already and you want to refinance to get the funds.
Yeah.
Yes.
Detached,
Couldn't do it the work though.
Right.
On your
yeah,
property.
detached would be Fannie or Freddie, but I would always go Freddie because you can use the projected rents in that to qualify for the.
If you have comps, yeah.
If you need to.
Right.
Which, just so you know, we have a lot of ADUs in this market, so finding comps, I don't think is typically an issue, so.
Yeah.
Yeah, that's getting.
I
way
can
easier.
give you, we are running into some issues. I have a couple in right now where a lot of people have built ADUs, but they're not rented and they haven't turned over. So we're seeing a lot of that right now. You know, because a lot of people will build these ADUs, but those properties haven't been resold yet. So there's not really, it's still kind of a new market in a lot of places. So we are seeing some, you know, pushback from appraisers on that because they're like, I had one that they had to go out 5 miles in 24 months and we only had one comp that had hit the market. So they are a little, they might be everywhere, but a lot of people are holding on to them. They're not like, doing them and selling them. And that's where it becomes a little funkier. So then as an agent, just do a little more research on it, see what you can find, That's not necessarily, if the borrower qualifies without rental income, then it doesn't really matter as long as they have the value, right? So it just might take a little bit more legwork on your end to make sure that it's feasible.
Well, hey guys, real quick, we're gonna go ahead and let Jim go, because I know it's month end, he's super slammed, but thanks, Jim, for helping us out. And then Josh and I will handle the rest of this, but
Okay.
you're awesome, Jim, thank you.
Yep. Okay.
Yeah. Thank you
Yeah,
much.
especially
Thanks,
for
Jim.
month end.
See
Appreciate
ya.
that.
Okay.
Yeah. He's like, you get 45 minutes, that's it. I'm out.
Oh, he clocked out real quick.
Yeah, it's like, thanks for the cue, I'm out of here.
Yeah.
So since you're taking over Q&A, this conversation just made me think of something else. It had to do with timeline. Because we put in an offer, we've got due diligence, we've got financing appraisal, but if we're doing this type of a loan, he's already indicated you guys can close really quick, but we've got proposals and estimates and review in there by you guys have to be done. So can you talk to that time frame? Obviously, it depends on how quickly the general contractor gets the
That's 99% of the delay. So it's not just the contractor, getting everything we need, but we gotta then provide it to the appraiser as well. And so if the appraiser's got questions on what the contractor gave, the
any
first.
examples of time frame.
So
stretches?
average turn time for us is about 43 days from start to finish on a renovation loan. Like you said, we can do it quick. It's gonna depend on how quickly the contractor. That is absolutely the key piece. There are contractors that will take 30 days to get stuff back to you. So obviously, and we have no control over that, right? But when it comes in, when you're doing this loan with Josh and you guys upload that to us, we've got to review it within 24 hours. So,
Do you have requirements on how itemized those proposals have to be?
Yes. yeah,
Yeah.
we have the paperwork that is completed. We call it a contractor one packet.
So there's a
Spelled out.
packet for the
Oh,
contractor
yeah.
to fill out.
Boom, this XYZ, just complete it all, yeah.
So the highlights are materials are separate from labor. A lot of normal bids, they're not necessarily spelling those two things out. This one has.
So everything has to be spec'd out, itemized.
And again, part of it's because the appraiser needs to understand, what work is gonna be going on.
What are you seeing from offer to proposal submitted from a contractor on
Like
average?
the
How long?
close time,
No, just to get the packet so that you can then get it reviewed and move forward.
I set 2 weeks. I add 2 weeks to the typical
Time.
time frame. Actually, I tell everybody 6 weeks. I only need 2 weeks to close a normal loan. I tell people 6. I guess by expectations,
But we're talking in the middle, so we're thinking more like on due diligence and financing contingencies to protect their earnest money. It's like, there's more to discover and find out that, oh, I can actually pull this off. Cause maybe the appraisal doesn't come in subject to the value that we were hoping for, and that's more out of pocket than they were hoping for, so they don't go forward.
I would think you could still probably just do a typical week for your due diligence, but maybe add one for the financing, since this is gonna be a component to that. And then right out of the gate, we'll start with the contractor quotes, right? Okay, we're writing an offer, okay, we're under contract, next day, contractor, or as soon as possible, the contractor and the homeowner, you're in the house going through deciding what you're gonna do. And then that way, they get back because they're gonna need some time to give us the quotes, right? Especially if they've never seen the house till just
Yeah.
then. And so that way they're doing that while we're working out the rest of the loan details, while, you're looking at a home inspection or whatever else is.
Could you give us access to what that packet might look like so that we can have some pre-conversations with our contractors on what would be required?
Yeah,
We can provide them,
yep, he can get that to you,
So
absolutely.
hopefully this starts some conversation like that, and I know Haley's still on there, maybe she does fix and flips, and so she's in that arena already, and so some of her clients are gonna gravitate towards that. Just pre-setting the expectations would be super helpful, so having a conversation with contractors beforehand, say, hey, we're putting an offer on this property, we need you.
Yeah.
And this is what's gonna be required, and time frames and stuff like that.
100%. Something else I wanted to bring up, so this actually happens, especially for the houses that aren't in the greatest shape. So let's say, for example, I'm gonna go, especially a first-time home buyer, right? Hey, this property is terrible, there are squatters in it or something, right? We wanna buy this. So you can actually include as a renovation cost, the cost of rent or mortgage while that house is being renovated. So you can say, hey, 6 months worth of rent while this house is being renovated is a renovation cost. I'm assuming the equity is gonna be there.
Phrases,
Yeah, so what Plaza does is every month, we're shooting off that rent or mortgage payment check. So someone could go buy just a terrible property and we know, hey, it's gonna basically be gutted and rebuilt, right?
Yep.
Absolutely.
So in case you guys are wondering where some of these numbers might play in, and Kaylee, maybe you can even speak to this, is you're helping your clients become their own flipper. They're gonna flip the house they're gonna buy. So, for instance, when Kaylee buys a property that's run down, she's buying a product that is in this condition. She's gonna make it a new product, and the value is gonna be worth her while to do that, right? Meaning there's a spread and there's a profit to do it. So if your clients can keep the profit portion, it still might appraise more than the renovations are gonna cost. Because they're making it a new product. The appraisal is based on something completely different. This is how I built my portfolio, is buying rundown properties, fixing them up, and then refinancing them based on the new value. So.
And I will say this, I don't think we've ever seen in the years that, and I get this from my team that, you know, they've all been doing renovation loans for years. Getting enough equity is rarely an issue right now. Like, I don't know, the return on investment has been really, really strong on these. So it's not very often we don't see people getting enough equity, but think about it in our market. I mean, we know there's houses out there that are just in terrible condition and people can't afford a lot. Think about all the options you have. You can renovate it and we know it's gonna be worth so much more. You can convert a basement into an ADU. Like, hey, we're gonna rent this out. Now I can actually afford to get this house.
And qualify with that rent.
Yeah.
Even though it's a single family.
rents. Yeah.
So that was 50% projected rents on FHA and 75% on conventional.
Freddie, just Freddie.
Just credit.
Yeah, so, and the other advantage to Freddie, and I don't know, I think this is still relevant.
Freddie Mac is one of the 2 conventional loans.
Yeah, Freddie allows you to use less of your projected student loan payments. So Freddie is always kind of an advantageous way to go, so. For a lot of these maybe younger kids that went to school and struggling to afford a house, it's a great way to get them in. Not to mention, how many times are we seeing people saying, hey, we want to have mom and dad living here now, or we want to have family living here, right? There's a lot of that with the inventory shortages.
Or like he said, make it disability compliant, you know, for access, handrails, widening doors, all that kind of
Hey,
stuff.
Jeff, you said 75%. Clarify that for me. What's the 75% number again?
Of the rent. So of the projected rent that you're gonna collect.
No.
So if you're building an ADU, you're buying a regular house, you're gonna build a mother-in-law or build an ADU outside or something. That projected rent, which is gonna come from the appraiser, they're gonna create a form that analyzes the rent of the market. We're gonna count 75% of that towards qualifying.
Understood.
As income.
And then it was just only in the last couple of months that FHA modified their guidelines, they're allowing 50%. But with FHA, you know, if you have those borrowers, maybe their credit isn't as good, it does have to be attached, it cannot be detached.
Right.
But we see people converting garages, right, into an ADU. Like I said, I mentioned the basements, but I think one of the great things is you can build an ADU. I know that there's.
I just built an ADU,
Yeah.
detached.
Yeah, well, I know up in Heber, there's people that are doing shipping containers and they're converting those to ADUs.
Yeah.
So,
Is that hard to get approved, the shipping containers?
I would say not now because there's similar comps.
Creating some.
Yeah, they've already created some comps.
It's the finished product they're appraising, though. I mean, you've got walls and living space and whatever, it doesn't matter what shell you're starting with. It shouldn't, right?
Correct.
Now, here's something else to consider. If you have a new construction home and it's not quite,
No, you keep going, we'll get the question.
it's not quite complete, we want the house to be about 90% complete. So you could go to a builder who hasn't, maybe someone fell out, right? Fell out of contract, but it's about 90% complete. They could still pick appliances, pick some of their finishes. You could use a renovation loan to complete that new construction. I've seen several of those.
Hey guys, can you restate, I know we said this, but I just want to make sure I understand this, the speed factor, right? One of the negatives perceptions is takes too long in that closing process to get this done. What is that timeline again?
So grab your question, and then I think, is it Kaylee?
Yeah,
Kaylee's got a
Kaylee,
question as well. I tell everybody 6 weeks. But if we've done 3 or 4 of these, we're using the same contractor in each one, honestly, 3 weeks should be pretty likely. like we'd be able to wrap it up. It just comes down to the contractor. They're not sitting in front of their computer. They don't have an email on their phone necessarily. Right, so they're not, so that's the disconnect.
So a traditional, let's say that everybody says a traditional close is 30 days, this is gonna push us out to 45-ish.
Correct. That's what I would set as an initial expectation, yeah.
But if you have, like you said, a relationship with a good contractor, you can close these in under 30 days. You know, I mean, he mentioned the one, it was 12 business days.
So that's why I was asking for their packet, because you can go to your contractor before, hey, I'm looking for this type of product, this is the type of loan we're gonna get. But he's an important part of that equation on how long things take, so you put in your offer, you need to get him in there the next day after acceptance and start putting his numbers together. And so you can set the expectations with the contractor, and John, you're gonna provide that for us, I can share
I'll get
that.
that for you. You bet.
Cool.
All right, Kaylee.
Okay, just a thought is, not only is affordability low right now, but everybody's out of cash because they became such consumers in 2020 and 2021. And so they're not even looking at these fixer uppers because they're like, I have no cash to even do this. I have to do the no money down loan, and then I just have to live with it. And so it's about educating on this opportunity. My question is, if a project requires a permit, is the bank or the lender requiring that permit to already be pulled before this can close?
That is a great question. So on a purchase, no. But we do want to know that, I'll just use this one as an example. It's my property in Green River, Utah. So it's like, we wanted to know what the approximate time frame was that the permit would get approved. So they'll ask that question up front. But no, on a purchase, no, you don't have to have the permits yet. If it's a refi, yeah, then typically we're looking for you to have those permits. But on a purchase, no, because you don't own the property yet.
Right.
So the only thing you really need to have then is just the contractor and what his bid is.
And everything broken
And
down.
everything broken down
Mhm.
in order to close.
And what we're looking for is typically, can this project be completed in about 6 months? I mean, I've had people ask about properties, you know, way up on the side of a mountain. How the hell are we gonna get contractors up there? Plus, it's the middle of winter and stuff. We might say, I don't think we can get this one done in time, right? Plus the fact that we might not be able to find a similar comp. But
Well, and you did mention at the beginning that it can be a case by case basis too, so
Yeah.
this isn't blanket apply to every single property, but most.
did that help answer your question? By the way? Oh, she might be on the.
Yes, sorry, I'm like holding a million things and walking. My other question is, say that in the scope of work that was presented to the bank, say there wasn't a fireplace in there, but the homeowners, you know, in this full remodel, and they're like, I want to put in a fireplace and I have the cash to do it. Are they allowed to just do it with their own cash? Or is it gonna like, sorry, is it gonna like flag the bank to be like, whoa, what are you doing when their picture guy comes to take progress photos, you know?
That's a great question. That is definitely a way to make something a lot more complicated, but generally, I'm going to say they need to talk to us, but it probably will be just fine. But we do want to coordinate, right? We don't want to send somebody out taking pictures and inspecting, and now there's another big hole that nobody knew about.
Okay,
So
okay.
it's the coordination.
Communicate. Okay,
Yeah.
What
thanks
they're
guys, thank
approving-
you so much.
Hey, Kaylee, one last thing, what they're approving is the contractor doing the work that they're loaning on, so I would assume that you could do that.
Yeah,
But at the same time, our finished product better be finished, right? Like, we
Yeah.
can't go in and have a whole bunch of other walls all torn out because new work's starting for cash.
Yep,
It's like,
well, they could do it during that 6 months, so they already closed on the
if
property.
we time it and communicate it properly, I think
As long
it's
as it's
fine.
done.
what we don't want is, we don't want to take and say, we're gonna give the subject to appraised value, what it's gonna be worth. And then other things are being done. I mean, I'm not saying that it would affect the value, but you know, what if it did, right? We're taking that risk in that piece, so
Mhm.
any of the work that's being done, I would probably just get an okay on it. So that might be as simple as just a quick question to the consultant or something.
You must just have somebody that builds fireplaces, because why would you have your contractor just do that too?
Well, because it might add too much to the house, right? Or like, say you rip open the house and you're like, okay, you're getting the whole thing done, you're like, okay, well. Oh man, I wanna put in bathroom here later on down the road. Can you add that into it and just have it plumbed out and not a finish?
Yeah.
That can be added in?
Yeah, I'm sure that shouldn't be an issue, especially if it's part of the initial
You
quote.
could probably add anything you want to the scope of work, because you're going off of the appraisal and it's either gonna affect it or it's not, and now you're doing this other work, but the
Correct.
appraiser's not giving you any value for that rough end, right?
Right.
So that's kind of where I was going through this whole thing, is like, the out-of-pocket cash outlay, regardless of what these say, is gonna be dependent on the concession that the appraiser gives for that future subject to value. So it's like, yeah, this looks great, we can spend $100,000, we're gonna have this new product, but how much credit are you getting for those improvements for the new value? So I brought up the fix and flip angle, because generally, if you're taking a piece of shit product and you're making it a new product,
Yeah.
if there's a profit margin in there, there's also an equity spread that could help with the LTV for the purchase, right?
Yeah, 100%.
We're coming up, I don't know how you guys are all on time, but we're at our limit as far as what I was aware that we were given. Obviously, there's more questions.
We
One
got
thing
a
I want to
sponsor
throw
here,
in,
go, wrap that up.
one thing I want to add in and then wrap up is just that we can add to properties too. Like this does include subdivisions. So if we're looking at like some little house in Rose Park that's 900 square feet, you guys want to make it a 1,500 square foot or something like that, or 4,000 square foot, whatever. Like as long as it works, the numbers work, it should be fine. Like that's an allowed piece of the,
Just one last question. How long has this loan program been in place? Is it new or is it somewhat?
it is not new. He's been doing it since the 90s. I started in 03 and I think my first one was in 05. So
That long, okay.
yeah, it's just
Awesome.
takes extra time, these perceptions, right? And so people are like, nah. But no, it's been here more or less the whole time.
Okay, good to know.
So if you've worked with a lender that's never brought it up to you because that's what you're doing, then the lender has kind of been dropping the ball. Right,
I guess so.
kind of.
I don't want to be throwing anybody under the bus, but yeah.
But to your point, I mean,
Yeah.
we want all our clients to know what their options are when
Yeah.
they're making a decision.
You're like,
and-
hey, I wanna buy this rundown property, but it's never brought up that they can do a rental loan. And
Right?
they just got
Right.
fucked.
Do you mind if I throw one other thing out?
No, go ahead, yeah, yeah.
Let's say you have a property that's super run down, you can partner up with that general and say, here's our plan, here's how we wanna renovate it, here's what we wanna do. So you can bring in potential buyers and we already have the plans drawn up. Here's our thought for this, here's about where we think it's gonna look great. There's a lot of people that do that, they even have color swatches and everything, hey, here's our plan for this property. So it might be. if
You were talking about a property like that.
Yeah.
You could mark it
So it
as
could be like a-
to be completed.
Yeah.
Like a new construction thing, like, hey, here's the old property we have, and here's our plan to fix it out to the buyer.
Yeah.
Here's our option, go with this.
Sorry, yeah, all this just keeps giving me new ideas and stuff, but could you then potentially get that appraiser to do an appraisal on Hillary's property, subject to those improvements? Before they even list it, so you've got, yep, it looks like if you do these improvements, you guys have said, here's the ARV. And then you market it at the after repaired value as that product, and this is what we're gonna do to it, kind of like a under construction, new construction home.
Yeah.
So we
Yeah.
could get all that done before you even list it,
We could, yeah.
eventually.
I mean, you could have people walking into 100,000 equity on properties, like, we see that pretty common. So people like 50 to
Especially with
100,
the ADU.
yeah.
That's a big deal.
So you guys are gonna stick around for a little bit, but
Okay.
Janet's here, I wanna pull Janet up, and how appropriate, we have a flooring company, professional, to tie right in with our renovations, and she is amazing, Janet, we've worked with her for a while, I think most of you in here probably know her, hopefully. And I think I printed your thing, to the printer, I'll go find it, your little coupon things that you're doing. So Janet, could probably potentially be part of one of these transactions for you.
Doing it for me right now.
Yeah, awesome. Okay, do your thing, introduce yourself, and then we'll grab your stuff.
How are you guys all doing?
Good, how are you? Good.
So, did it work?
I want to leave the printer downstairs. We got a little
I'll
chill.
start going.
Yep.
Okay, so I'm Janet Allen.
You gotta get centered.
Okay.
And right there.
There we go. I'm Janet Allen and I am with Factory Flooring Direct. Here's our new little logo. We just made this. So I have these for you guys. And we are a company right now out of Lake Point in Twillip, but we are opening a new place in Draper. So cabinets will be in like 4 weeks, so we should be up and going within 2 months. So it'll be a design center, a flooring design center. We've been around for 20 years. I've been in the industry for 25 years, worked for builders and subcontractors. So I've kind of been on both sides of the spectrum, for which helps clients a lot, all your clients. And we sell carpet, laminate, LVP, tile, hardwood, and install. So we do all of that. We have a lot of stock products, and so that's who we are. And then what we're offering is a discount program or referral program. So no cost to you, and it's for realtors. The best way to do it is to contact me, like in a 3-way text, and you just register. I'll give you a little, it's free, and I'll give you a little card that I can have. And what you get is 10%. Your client will get 10% off their entire invoice. So that's pull up, that's the material, installation, everything. So, and then they'll get me, who walks them through the entire process. They have one person to deal with. So it's a lot more control as far as that VIP experience for them. So, let's see.
And the realtor then looks much better because they just saved them
Right.
$250,
Right.
$200 or whatever.
Exactly. And so, and then for the realtors themselves, for their own personal home, we'll give you guys a 20% discount.
Okay.
So, and then if you have any flips or anything, we'll match the client discount for you, anything like that.
Nice.
So, yeah, it works so good. We'll do a free measure, like I say, walk you through the whole thing from start to finish. And we have our own in-house installers. We also have free restretching carpet for life. So that's, no one offers that, which is kind of nifty. So yeah, that's the deal. So here is the card. I'll pass these around. So there's a little QR code that you can scan. I'll put that. What do you think of that? So you can scan it, and then you just register your name, phone number, and your email, and then that alerts me. And then what I will do is, in case that didn't print, so I will send you a digital coupon with your name and then whatever you want your business name to say. And then you can send this digitally, snapshot it to your clients. And so it's a great marketing tool, or just a way if you want to reach out to your client list, email them this or text them, just say, hey, remember I'm your realtor for life, here's a discount. That way it's kind of a reminder to them that who you
It's
are.
like a little advertising.
Yeah. Like marketing
Yeah.
for you with
And
your
for you.
specific name, right? And
It's
for me.
perfect. Co-branding.
Right, teamwork, so.
Well, a lot of agents say, well, yeah, I know I should reach out to my people, but I don't know what to say, or I don't know what to
Right.
do. You just have to have something of value to
Right.
offer and say, here, I got something for you.
Exactly.
That's
And
what
that's
it takes,
exactly,
right?
that's exactly what this is, so it just helps us all in the networking marketing, so you can pass those around. Anyone who wants to register, that takes 2 seconds, scan it, check it out, so, any questions?
Where's your location in Drake, or is it out here?
It's just right over here by Kohl's. So really close, just right off 123rd, I wanted it right off the freeway, so that, it's just.
Big point, I'll stay there as well.
Mhm.
So it's
Yeah,
nice.
that's our main one.
My family all lives down.
Oh, really? Okay. Yeah, exactly. So, yeah, and then here's like.
So to get that co-branding thing,
Mike, I come back to what?
so to do the co-branding, I just need to call you up.
Just scan that little QR code
Mhm.
and then register your name, your phone number, and your email, and then it will alert me, and then I will email you then you're in the club.
That.
Right? It's so great.
I think you did a presentation right after I ordered all my flooring.
Crap.
So this is the one that you emailed, but they don't want one that has.
Less than-
Right, this, I'm just showing them as an example.
Oh, I thought it was
Like I-
print those out for everybody.
No, I had someone else,
Okay.
so I just thought I might as well use yours.
Perfect. So here it is after you're done.
Right, so yeah, each one of you, and one thing that I did for Lynn, is I actually printed these on, like through Alpha Graphics, cut them this size, and she stuck them in her welcome baskets. So that's another option too. you know, or if you, so it's kind of nifty, but it's, you know.
Awesome. You guys got any questions for Janet? Thank you.
Okay, and I brought you cookies. We've got village paper.
Thank you much.
Little toasts and cinnamon rolls.
Oh, awesome. Thank you. Hey,
Okay, thanks, guys.
I don't have to say goodbye to anybody there. All right.